Thanks. That was our tireless Andy Bell. Stay tuned for Bloomberg Markets After Market Call. But now, it's time now for our top picks with Darren Sissons. Darren, I saw this one and I thought of you immediately. Auckland Airport, ticker AIA on the New Zealand Stock Exchange. What's your thoughts on this one?
Yeah, well, it can actually be bought in the US as well. So effectively, this is a recovery story, but it's an underlying infrastructure asset that airports tend to perform very well over long periods of time, raise dividends, and effectively revenue growth is driven by passenger volumes. And those who followed the New Zealand COVID story know that they effectively locked the country down and turned it into a hermit kingdom. So they opened up the economy partially in May and then fully in July, and the month-over-month passenger volume growth in June was 145%. A slew of new routes have been announced, and the country is now open for business. Revenge travel is happening in Europe; it's happening everywhere, and that will continue to grow. There's a number of redevelopment plans, and the contribution margin associated with earnings for passenger volume is parking, concessions, hotel stays, all that will spike, and there is a redevelopment plan as well. So we think at these levels it's a reasonably attractive longer-term hold. We like the airport space. We think it's a lower beta return relative to airports. So this probably will end up being a long-term hold, and we do think that the dividend will be reintroduced now that after one quarter the company became profitable. So of one quarter of the market being open.
And always a good excuse to go visit New Zealand. It's on my bucket list. Let's turn to your next top pick there. I'm not going to pronounce the full corporate title of this, but I know it's the chocolate maker Lindt on the Swiss Stock Exchange, ticker symbol LISP. Why is this your top pick?
Yeah, so this is actually the participation unit to be share, not the underlying share, as the participation share is 1/10, and it's about 14,000 Canadian dollars. So it's a high valuation stock, not something we would normally recommend going into a recessionary environment. However, given that small treats, affordable luxury, I think it does sort of suit the bill. Perhaps one of the things viewers want to think about is that in Canadian dollar terms, the 5 and 10-year total return growth path has been 13% per annum and almost 17% per annum from a total return perspective in the last 10 years. So we think it's very attractive. The pension fund owns about 20% north of 20%, an asset-light business model that needs very little capital to grow, and a global scope of operations. Chocolate consumption is tied to rising wealth, and people every year are consuming more high-grade chocolate. And I think that if pricing moves higher by 10 or 15%, people are not going to avoid buying their Lindt Chocolate fix. So we like it. We've owned it for quite a period of time, and it's been very successful holding. And we think at these levels, now that it's down a little somewhat, it's actually worth adding for a long-term hold.
Darren, do you have one of the, what's your favorite color for Lindt chocolates? Mine is the red, the milk chocolate one.
To be fair, I don't have a favorite. I like them all. I like them all. And I prefer I prefer the 85 or 95% chocolate grade. So it's any Lindt's good for me.
I'm also a fan of the seasonal options. All right, let's move to your last top pick. It's Shell, the oil maker. Why is this your top pick?
Yeah, so I think, so perhaps one dimension is that we will see the ESG mandate is pushing energy companies effectively into the sin stock category. And what that's effectively meaning is that valuations are coming down, earning yields are rising, total return story will be attractive. Given the high level of oil, the company has delivered very aggressively. They're buying back stock, and they obviously have the renewals optionality. So I think you put it all together and you look at an inflationary environment, riding commodities from an inflationary platform that is energy gives you a great pathway. The company did cut their stock for the first time since I think it was 1947 during COVID. So a very good management team. They moved headquarters to the UK to get away from the ESG issues, particularly out of the Netherlands. And so at these levels, we think this is attractive. We think there's more upside. So we own it, and we are recommending buying it for new clients as well.
It's a company that is also sensitive to risk. We're seeing a headline on the terminal today how Shell has suspended gas deliveries from South German storage. What are your thoughts on how those kind of risk events could impact Shell's trading price?
So you've got to remember what they actually do. So they are the producers, the manufacturers, the movers, the transporters of highly flammable liquid. So whether they're in hydrogen, whether they're in gasoline, there's always the scope for a disaster or perhaps an issue, and perhaps risk management is required. We saw that with BP in the Gulf of Mexico during Macondo. So there is scope. There is always that potential. But you've got a company that has significant economic footprint. They have risk management protocols. We have not had any major disasters like BP in recent years. So if they're telling, so it's, I think from a practical point of view, I'm not concerned by that risk.